A major UK housebuilder just admitted something most people missed. Not in a panic announcement. Not in a crisis statement. In a quiet trading update that tells you exactly where this market is heading. And it's not good news. House prices didn't crash this week. On paper, the market looks fine. Homes are still being built. Mortgage rates have come down from their peaks. Headlines aren't screaming. But under the surface? Something quieter is happening. Taylor Wimpey, one of Britain's biggest housebuilders, just released a statement. And what they said should worry you. Demand is muted. And 2026 will be less profitable than 2025. Not because they can't build homes. Because the maths of selling them is starting to break. See, in a healthy market, builders don't need to trade margin for momentum. They sell to normal buyers. At normal prices. With normal profits. When that stops working, the system doesn't collapse instantly. It starts to bend. Quietly. Slowly. Until one day, everyone notices. But here's what's really concerning. It's not just about Taylor Wimpey. It's about what their numbers tell us about the entire market. Let's look at the pipeline. Taylor Wimpey's order book, the value of homes reserved or sold but not yet completed, fell to £1.864 billion, covering 6,832 homes. A year earlier? Closer to £2.0 billion. Now, that doesn't sound dramatic in a single headline. But it's a directional change. And in housing, direction matters more than speed. Because the order book is what keeps the next 12 months alive. It tells you what's already in the bag. And if that bag is shrinking, the pressure moves forward. Into 2026. Into next year. Into the future. Here's what most people miss about builders. They don't just build. They manage cash flow. Land obligations. Labor and subcontractors. Investor expectations. So when private demand weakens, builders don't simply stop overnight. They change the shape of sales. They lean harder on incentives. They do more bulk deals. They slow land buying. They stretch timelines. And they accept lower margins. Because the alternative is worse. On paper, it looks like stability. In reality, it's a quiet form of stress. An absolute grind. And this is where market psychology comes in. Because what's happening in people's heads? That's where the real damage starts. The UK housing market doesn't just move on interest rates. It moves on confidence. The feeling that buying today won't look foolish tomorrow. The feeling that your mortgage payment won't jump when your fix ends. The feeling that if you need to sell, someone will be there. When that feeling fades, the market doesn't always crash. It freezes. And freezing is destructive. In a system built on constant movement, constant churn, constant transactions. When that stops, everything backs up. You can see the freezing in the mortgage data. November 2025. Mortgage approvals for house purchases dipped to 64,500. At the same time, remortgaging approvals rose to 36,600. That split matters. Because it shows two different UK housing markets living side by side. One market is trying to buy. The other market is trying to survive. When remortgaging rises while purchase approvals soften, it means households aren't thinking about upgrading. They're thinking about payments. About fixes ending. About what happens when the cheap deal disappears. And that's where the system starts to strain. Now add the price data. Because what's happening to house prices right now? It's not what you'd expect. Now add the price indices. Nationwide says annual house price growth slowed to 0.6% in December. Down from 1.8% in November. Halifax reported a 0.6% monthly fall. Annual growth at just 0.3%. This isn't a dramatic price collapse. It's something more awkward. Flat to soft prices. With transactions under pressure. And that matters because housing relies on movement. If prices stall, sellers hesitate. Buyers negotiate harder. Chains break. Estate agents start saying, just wait until spring. Meanwhile, the calendar keeps moving. Fixed-rate deals keep expiring. That's the quiet pressure point. Not panic. Not headlines. Just time. This is where first-time buyers come in. Taylor Wimpey's own statement pointed to subdued demand. Particularly among first-time buyers. Even with some improvement in affordability. Think about what that means. First-time buyers are the base of the entire chain. If they pause, everyone above them slows down. The move-up buyer can't sell. The downsizer can't find a committed buyer. The landlord can't exit cleanly. And developers feel it first. Because their entire model depends on forward sales. Predictable pipelines. Steady reservations. So if first-time buyers are cautious, builders start compensating. More incentives. More contributions. More deals that don't show up as a simple price cut. A quieter discount. Because official prices are sticky, but margins are not. Now here's the contradiction. Taylor Wimpey has cash. Lots of it. So why should we be worried? Here's the contradiction. Taylor Wimpey ended the year with net cash around £343 million. That sounds reassuring. Cash buys time. But cash isn't the story. Confidence is. Builders can be cash positive and still be trapped in a weaker market. Because they still need to sell. They still need the order book to refill. They still need private buyers to return. Not just institutions absorbing stock in bulk. When a builder warns about margins, it's a signal. The pressure is moving from consumers into corporations. And once that happens, knock-on effects follow. Land buying slows. Build targets become cautious. Sites get phased more aggressively. And affordability problems don't disappear. They just shift onto the next group. This doesn't look like 2008. Not yet. Back then, the shock was credit. The system snapped quickly. Today, the system is under stress in a slower way. It's more like a grind. A long squeeze. Where prices don't need to crash to cause damage. Transactions weaken. Refinancing pressure rises. Builders discount quietly to keep completions moving. And you get a housing market that still functions. But functions badly. People delay moves. Families stay put. Renting becomes prolonged. New supply becomes harder to finance. And the ladder? It becomes less like a ladder. More like a wall. So where does that leave us? Taylor Wimpey hasn't announced a crash. They've announced something more telling. Muted demand. Lower margins in 2026. A smaller order book. And a market where keeping volume moving requires compromises. At the same time, purchase approvals are softening. Remortgaging is rising. Price growth is drifting toward flat. This isn't a prediction. It's a snapshot of a system under pressure. And the pressure is quiet. It shows up as hesitation, as negotiation, as margins that don't recover. Because on paper, it looks fine. In reality, it isn't. If you're in the UK, I'd love to know what you're seeing. Are new build incentives getting bigger where you live? Are buyers still turning up, or just browsing? Coming off a fixed-rate deal this year? Drop a comment. Tell me what's actually happening on the ground. Subscribe for calm, evidence-based breakdowns. No hype. No noise. Just the data that matters. This isn't the end of the UK housing story. But it might be the moment people realize. It's already changed. See you in the next one.